Ladies and gentlemen, this will go down as one of my most famous videos. Are we about to see the biggest bounce in the stock market that we might ever see, at least over the next couple of years? The VIX is back above 20. You know what that means? If you don't stay tuned later in the show, I'm going to explain it. Stocks are crashing, but so are bonds. And with bond prices going down, the yield goes up, which adds further pressure to the stock market. Institutional cash is just sitting on the sidelines, waiting to make a decision. SPX has made it way down to those historical support levels that always have turned out to be the absolute best buys in the stock market. So what are we going to see? GDP, it's exploding. Enormous growth figures released today. That's fantastic, right? No! The truth is, of every quarter pre-recession, there's a huge boost in GDP. The fear and greed index completely exploding. What does this mean? Well, I think it could turn into a relief rally. I think that we're about to see the biggest bounce in this market cycle for sure. And I believe we could see the stock market storm into new highs. But what's the catalyst? Welcome to Tradespotting. That GDP growth figure, right? Sounds very good. Sounds very, very positive. But back in the dot-com crash, there was a 3.97% increase in the same quarter that we're talking about. In the lead up to 2008, there was a number of positive increases in GDP before everything started to fall off a cliff. And then if you go back further into the late 70s, 80s, look at some of these huge, these are 4, 4, 4, 4, 3, and then there was a huge crash again. And if we're looking back even further, this is true since forever. There's the 70s. You also had a similar crash. You're talking about 5, 6, 7% GDP growth per quarter, followed by a huge crash. So, I suppose I should show you what site that's from and whatnot. But the data you can find yourself, it's US real GDP growth rate by quarter, and you can then line that up on the chart with recessions, and if you don't know when they were. So that's a really disheartening point about the GDP growth. But wait, there's more, and it could be critical. So if that news comes as a little bit of a dampener for those previously enthusiastic with regards to the GDP news, then this will come as a multiple stabbing attack. As you can see on this chart, we've got the gross federal debt as a percentage of the gross domestic product. And as you can see here, we've exceeded the all-time high in 1946 after the Second World War on this most recent move to the top side. And what was resistance is now looking to be support. If it continues on again, you'll see it up at 131. It's another 20 points. If that breaks, 157. So, and here we have the previous technical analysis we did on VIX, very successful number of times. In your channel on the daily time frame, we spoke about how you held the 50 simple period moving average itself coming up for a cross of the 200. So pay attention to that. Price action pushed above the top side of the channel after it took a hit from the basis line, came back, filled a rocky outcrop flash, a test of that 50 simple period moving average, and the golden pocket retracement. Subsequently, it's gone on and put in a new high. It's found support at that basis line. And now if it does push higher, having tested the 22 target, remember, this is where we got to, then you're looking at the next guy being 27.50. If that breaks, you're looking at 28 and change. That's huge levels on VIX. That's massive, massive percentage moves. Obviously, you've seen something not tiny recently in these $12 up to 20. So similar moves coming again on VIX potentially if the volatility increases. And the volatility has on VIX, as you can see, spiked a number of times. On those occasions, you've come up, tested the basis line, found support, gone on, tested the top line of this downward sloping resistance in the channel. Similarly here, you found A little bit of resistance before finding support again, going on up. A very sudden retracement back down again, because when prices top or bottom, they tend to have huge reactions. Those huge reactions may be in the process of happening right now. And as you can see, there's a number of occasions here where it's found resistance at the basis line of this channel. After finding support, the next target is the top side. Not so similar here, having had such a deep retracement back down again. But it's true to say that as it was coming up, testing the top side, a number of areas coming in, testing the basis line on that move. So is this that same move? We've held the 236 subsequently to come down, testing the basis line. That could be a high or low if you're putting it in the context of 1, 2, 3, which is all we really need to go for the top side. So it is very, very possible that VIX is about to make a massive explosion up again. That's on the daily time frame. On the 4-hour on VIX, you can see how clear that formation is. The test of the 50 simple itself above the 200 period moving average. The 236 at 20.99. VIX itself trading at 20.67. So just below there. Is volatility going to drop below 18.88? That is the question. If VIX drops below 18.88, SPY might be slowly creeping back up and starting a relief rally. So that's what to pay attention to on VIX. If VIX starts dropping below 1888, if it starts moving above 21, and in particular 22.22, and then exceeds this little high at 23.29, well, you'll probably be seeing SPY fall off a cliff. So watch out for those figures on VIX. We have been talking about this chart for ages. I'm so eager for you to pick up what I'm putting down about SPX. And it's not simply the significance of the statistic that's been true since 1951. That is that from the lows in a market downturn to the subsequent highs, the 50% line, that's this retracement here at 4075, 4065, that sort of level on SPX. That level since 1951, if price gets back there, it's been the best buy in stocks for that market cycle. And I've marked out on the chart here everything you need to know to make it as simple as possible to take advantage of it, right? It could come as low as 3939 on SPX, a golden pocket retracement, and move on up again. Why? Because there's so many stops here. That's a lot of liquidity. Markets seek liquidity. And so it may well be that price wants to come here. If VIX is moving above 22, then it may well be that you're seeing SPX push down to below 4,000. So watch for that. The opportunity, though, has already begun in at around 4187 to the support level we thought would be tested, which we saw today in at around 4145 to 4120. As you can see, 4137 now, low of the day, 4127. So this opportunity, well defined, the starting point of it, present. And right now, how do you take opportunity? Well, you can manage this opportunity with a stop. You can wait and be patient. You can enter, scale in little bits here and there so that you're not losing too much if the price drops, and you get a significant percentage or position size as and when price makes its ultimate low. Or you could start now, put a stop in at the most recent low we saw, 4127, and then try and re-enter if it pushes lower down to 405, 4045. Or you could wait until it gets all the way down to 3935, 3945, and have your stop just beyond that at 3895, waiting for a really deep push back down again, loads of value, and a move back up. The problem with this zone and the increased liquidity and any retracement that goes beyond standard retracement levels, for first instance 236, then a 382, and then getting critical at the 50% retracement, and then beyond that golden pocket, anything that goes down to these levels, especially if that is taking it below an important support, which is the prior high from the previous trend, then you're in a zone which is full of stops, and that creates a lot of volatility that goes with the liquidity of those orders, sometimes market orders. Sometimes there's liquidations happening. And when price gets here, you don't know where it's going next. Just because it made it to these levels and that follows with the TA that you've been served here, that doesn't mean that straight up now it's going to bounce, because the determining factor is the trades in this zone. And if the selling pressure is so high from stocks that are triggered here, then price will collapse down and you'll see huge craterous moves on the stock market. But even getting here is very, very significant. And I certainly think there's potential for a bounce. This is the opportunity beginning in this zone. This is where we've seen big historical bounces before. That's all well and good trade spotting. But if the Fed don't stop raising rates, then it's going to put increased pressure on the S&P earnings yield, which the Fed want back down. They want it below 5. They're keeping it close to the Federal Reserve's yield on Treasury bonds because they want to shift those bonds from the public sector into the private sector so that the government is free to take action ahead of any necessary financial stimulus in future, which they believe is coming in future, not now, in future. So a relief rally off the back of a bounce, turning into a massive new high that exceeds these previous levels. It's very possible. You've got gaps in the market to aim to. One of them on SPX, that's 4395, closes around 440. You have another at 4555, closes around 4580. These are two targets to the top side. If you make any sort of a bounce on SPX, obviously a derivative of SPY, from where price action is now, and bear in mind, this downward sloping formation here, that also looks very much like a channel to me. If we make it white, let's even go one further. Let's make it a parallel channel. Take these highs. Those most recent touches, 1, 2, 3 on the top side, and then you've got more than 3 underneath price action. If I extend this guy out, excuse me, then you've got a very linear progression in the current trend to rely on if prices to continue to the downside, though we expect it to meet horizontal support at a number of occasions. It could well bounce here. You've got a basis line to worry about, a previous 382 that could now be resistance, but it would be a massive to see SPY now pushing above 4.3, SPX on 4.300. Then you'll likely see price fall down at that stage. If it does come down and test these levels, this is the start of a huge opportunity and it could take a massive bounce. If not, you've got a picture of potential liquidity and volatility. So volatility, that is the distance that price will travel over a given period of time. That range could be seen to increase if VIX is going up. If it exceeds 22, spot 22, SPY may be dropping, SPX may be breaking really low to historical support levels that have always proved to be a good buy. Really good look at SPX. Let's now check in with SPY quickly and confirm our TA here. We've got a picture of a potential breakdown. We've drawn it on the charts and price action has gone very well. When we put this on, we speculated that there would be this potential double bottom and that would provide us with symmetry in the market. That symmetry, the point of symmetry coming along this horizontal. And as you can see, we did get that double bottom. We got that W reaction. And we also, unfortunately, came through with Tradespotting's lines and predicted this double top, fill the gap, come up with a divergent double top, meet the resistance, 1, 2, 3 touches of this previously, making this very much a real level of resistance. And you could anticipate then more of the same as a trader. We look for continuation. So this bounce down lost support as we anticipated it potentially would, because as we said, if you go back, you'll see this would form a lower high, which of course it did. And so then price in that trend goes and seeks a lower low, lower than these lows, which we got. And we've broke below this important level of support. We have a potential bounce, but this is a massive rejection wick on the 4-hour candle into close. And it looks as though then the gap fill on SPY in at around 409 may be happening, absolutely closing in around 405. If that doesn't hold, you've got the next target. You see it there as I open the chart. It's open in around 395 on SPY. Absolutely cataclysmic news for equities. And the mechanism that's supposed to save people's money is when equities crash, they seek safety in bonds. That popularity of the product represents demand that outstrips supply, pushes up the price, and keeps everybody safe. It's why there's a split in portfolios, and it is the traditional hedge, but it's broken because bonds have been crashing, because the yield keeps going up, and now people are starting to wonder, are they going to be able to pay all of this back? Which means they'll demand an even higher yield, putting even further pressure on equities. So a very dangerous game being played by the Fed. Thank God I thought of this before I published the video. I realized after I'd finished filming that I hadn't expressed how it is that you could make money of this. Of course, I've helped people manage when you get to the end of the video, you'll see I've gone through so many little bits of information that should help people no matter what ticker you're trading. But also, what about the people who aren't trading yet and are waiting to invest? What are you going to invest in? Especially those people who've been waiting because they are very cautious traders. Well, I said months ago that this moment was coming when bonds were going to flip. They were going to suddenly go up in value loads. The reasoning is because bonds aren't exclusively determined by how many of them exist in the world. Their issuance is part of liquidity in the financial system, especially in America, where you buy houses. So they're going to keep existing. And then the supply of them might be outstripped by demand when people flock to safety, if it is that the stocks are about to crash. Or it could be that when rates are about to drop, bonds start to go up because nobody wants them. So the price of them has to go up in order to sell more of them. So there could be a really big opportunity in bonds for people who haven't yet invested in anything, something to pay attention to. Because if the market crashes, bonds could skyrocket for safety. If it's the other way around and the market doesn't need any safety, then it may well be that rates do start going down and the price of bonds go up again. The mechanism being broken at the minute means that it will eventually correct. And the mechanism being broken at the minute has seen the return of the bond market vigilantes. These are the market players who punish governments that stray from strict financial rules, the norms for running your society. If it causes concern, then they take action which causes concern for finance ministers around the world. And in recent years, governments who enjoyed a luxurious borrowing environment, sometimes even citizens paying to lend the government money, such as Germany, things have been correcting now. And the US 10-year bond giving 5% return. In Germany, you get 3% on the equivalent. That's a big difference from paying the government to take your money. The rise in bond yields has occurred during a time of obvious increased global tension, which defies typical market behavior and leads to the problem that we're seeing in the bond market at the minute. Wars usually trigger a flight from stocks into the safety of bonds, and US Treasury bonds being the most popular choice, that gives them status as the world's safe haven asset. It's a moniker that's not actually the truth, but it's the way people describe them. And so, however, at this particular time, that's not happened. Even after the added tension from the Israel-Hamas conflict, US bond yields continue an upward trajectory. So what's driving the trend? Inflation, it might have peaked. It's now falling in many Western economies. I've explained recently, interest rates are at their near peak in response in terms of, there's a lag in terms of the regulatory action in response to those inflationary figures. But those interest rates now likely going to start coming down. And those main factors that would typically drive the price of bonds really confusing people. What is driving the trend then? Factors that should theoretically boost the prices are actually causing them to fall. And a lot of experts think that this is due to two main factors. First, governments worldwide facing dire financial situations. So nobody trusts them to lend them money. And so the rate goes up. And so the price goes down. A big, big problem. Secondly, central banks like the Fed and the Bank of England are actively selling large amounts of their bonds into the open market, as I explained and have been explaining for months now. So people are wondering what's the next level that these institutions can take with these tightening liquidity conditions. And it's very, very difficult. They haven't got many different places to move. Everyone trying to offload previous quantitative easing has sucked all liquidity into that one particular asset, which draws it away from everywhere else in the market. So this is the problem in the bond market. That's why all the money's going there. You need a liquid environment for companies to grow and expand and grow the economy and pull themselves out of recession. So without stimulus, it's very difficult to get the ball rolling again. And people emphasize that this increase in bond yields pushes up the interest rate in terms of government debt, which makes the problem even worse for society. So something that was theoretical will soon start really, really hitting home. And it's going to make people really, really angry, which is going to cause the government to give everyone free money. And then everyone's going to invest in Clovergate. Only joking. But this is a natural evolution. It's a perfectly logical, rational explanation for. And here is the absolute bloodbath. It may well be a fountain of dreams for you, depending on your inclination and how you position your trades. But this is XLK. It's the select sector. It's those companies in SPY that are focused on tech. So just this tech sector, that's the largest growth sector within SPY, and it's been crashing. Growth absolutely disappearing because the earnings from these companies is under that which is offered by the Federal Reserve or the Treasury bonds. And so if you're getting a better return on a risk-free investment, then what's the point in putting your money in equities? You would lose it through attrition and entropy. Here we can see that bloodbath and what will happen. So we have this potential trade set up from back in February 2023. Happy Valentine's Day. And you could see that price action formed this channel. You were only basically holding the basis line within this. Very, very weak price action. Managed to come back up. You got a little bit of a gap. That's to potential volatility and a retracement back within that channel, which you obviously saw. Beyond the gap fill, come back down, putting in a higher low. You got divergent lows, price pushed back up to the top side. And these were the lows in and around May in tech that gave us a butterfly harmonic on SPY, which allowed us to close really good trades at that point that were short and push it on up with our portfolio. So now we're looking at the vice versa. Price action's come up, it's put in a double top, it's put in a potential Eve Adam formation, and this retracement took you lower than previous lows within price actions previous part of this formation here. So that's quite negative in that you're putting in lower lows. You've got a touch of resistance then to look to, 3 touches here, but that's not giving you any sort of a formation other than confirming that this is a really tough level to break back above in at around 92. Currently trading at 86.94. So pushing up post-market, a third of that what it lost during the day. Is that bounce starting now? Well, this chart doesn't necessarily look to be showing us so, and we do have rocky outcrop flashes showing us insane amounts of profit could be made if the breakdown is about to happen. Onto the daily time frame, and they're also there, jeepers creepers. Back up to the weekly to make this point about how well tech's been doing, and my goodness gracious me, that's not coming anytime soon, surely. Right, so weekly time frame here, you've got a very, very dangerous formation, though you do have a potential support line. I know that that's a little bit just very debatable. I would agree with that, but you've got touches there, 1, 2, 3 wicks and a body, so 4 in total. It's very real. Price action isn't quite meeting it yet, and that does speak to the fact that you could come back down, find support at that diagonal, also meet important horizontal levels, which you also find rocky outcrop flashes in at around 83. So you'd be losing 3 off 86. That's, what's that, 5% something. And then you've got 81 and then in at around 80, right? So that's huge, right? 5 to 7% off the top of XLK would speak to big drops in big names that you'd recognize. And if that is happening, then they would likely be leading SPY moves and VIX. So here we have this formation. I think that actually says an awful lot, though if you want to ask me questions, please let me know in the comments about anything you've seen in this video. And if you think it's worthwhile, now would be a good time to hit the like button. So price action, there's a high, a more recent high, that's a higher high. These lows, okay, these have been higher lows, but you've also got this tightening price action where you've come in and you've found a degree of resistance on the top side. That resistance has less of an inclination than the support. It leaves you in this wedge, and it's very, very dangerous because it gives you a measured move from the lowest to the highest section within price action there. And if it is to break down, then this breakdown would take you way beyond any sort of rational level. Oh my goodness, it's so bad, right? So you'd be looking at this making the extreme low, probably fill in this gap in at around 70, and you'd be looking for a support at 69 on XLK. And if the XLE, what's that? This is not supposed to be XLE. This is supposed to be XLK. Is that XLE? This is energy. Oh my goodness, isn't that good news? Well, I might just leave this section in then, because if energy is coming down, the price of energy is coming down, then that'd be a big boon to the economy. It would be very good news for the inflation figures. The Fed would take that concrete boot off the gas pedal, and it may well be that you'd see SPY move to the top side. So we'll leave that section in, but we're actually looking for XLK, which is the select sector for tech. And it looks terrible. I've also got this very strong question mark on the go now. You've got a horizontal level and a diagonal to pay attention to. We'll go at the daily time frame where you can see that you've broken below that important horizontal, and the diagonal speaks to the potential for a similar formation coming on the other side. And if this is resistance, 1, 2, 3 touches, you can see that you've got something not dissimilar underneath. It may well be that price action is in that channel and you're looking at continuation of that downtrend. Lower highs followed by lower lows. So far, so good, if that's your way of looking at things. There's a little bit of a gap there. It looks like it might have just been filled. So we'll see, but there are others, and nor does this have to be in select sector ticker. So you've got your horizontal level. Mostly that's defined by one previous touch. So you're not necessarily anticipating support there. I don't think a diagonal trumps it, but you did have 2 touches, so you might be looking for this in continuation to take you lower in at around 155. Trading at 160 at the minute, that's a big dip. Right, so you've also got a potential basis line within that channel. We could draw it on, but the channel's not had 3 touches to the bottom side yet, so it's speculative, and we'd be then extrapolating from a level of distortion in order to use a basis line from a formation that itself hadn't proved to have any validity yet. So if price action is to continue, though, you could anticipate that validity being shown. It may come with rejection of this previous level of support, which would then also probably be the basis line within this channel if price is to move back up again. And failure on XLK to make it back above 162 would speak to the likelihood of coming down and testing 154, 153. That would be leading SPY down as you watched VIX move up. So a little bit dodgy there on the daily time frame. And if we do go then down to the 4-hour, lots of previous targets. This was from a long trade that we were discussing back in March and talking about the advantage of this particular select sector if you were looking for volatility and really good longs. But that was off the back of that harmonic and the butterfly I was talking about earlier. So you've got these tests then. You've got 4-hour time frame, 50 simple below the 200 period moving average. The 200 period moving average meets this downward sloping resistance. Price action pushing beyond the previous low. That's all very negative. The only thing that does give you a little bit of positivity is the fact that it was maybe inevitable to come down and test this particular area where price broke back above highs from this breakdown formation in around these levels. Found support once. It was perhaps inevitable you would test that huge gap, what with it being 50% off the peak that you reached thereafter. So coming to these levels and testing 155 to 153 on XLK may be where you see a big bounce. And if it drops below this and you're holding stocks in a margin account, which itself could then be at a threat if prices drop significantly, and you're looking for a barometer to measure those particular stocks in tech themselves, all often at multi-year lows. I'd agree with that, but that doesn't necessarily mean it isn't going to go lower. Trumping that statistic is the trend, which will trump all statistics. 50% retracement coming in at around 155 on XLK seems very, very possible. And all of that being said, this isn't yet a channel or a wedge, not having had a third touch to the bottom. And previous to all of that, it was in an uptrend. So that's very interesting. And part of the reason that that's interesting is because when the US government notices that the economy is in trouble in a critical way, they call in the plunge protection team. This is when the president gets the head of the Federal Reserve and some of the top banks into a room for a private meeting with what is officially known as the plunge protection team. And they are directed to go out and immediately start buying US equities, futures, and option contracts, as well as the underlying. So is that going to happen? That would be a halfway house between keeping rates as they are and enacting a form of stimulus. It would be a little bit old school, but it's definitely very possible. That was your take on what's coming on the stock market, how to manage any positions you might have at risk by looking at critical factors on the charts and the values where you'll be able to make your own determinations. There was an awful lot in that show. If you liked it and thought you got some value from it, please hit the like button. If I've missed anything, I hope not, then I'll cover it tomorrow in even greater detail. I appreciate you. If you're a returning viewer, thank you so much. If you're new here, I'm Tradespotting. I do my absolute best to show you that there is no help in rushing to be rich. There is plenty of wealth in waiting to be right. And bing bong, the price is wrong because the economy and the stock market, they're two different things, one of which you speculate on and you buy at the lows. See you tomorrow.